Prepare now. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, California has fallen. I'm going to show you what's going on in California and why it's soon going to spread all across the country. And with the U.S. economy at an inflection point, can the Federal Reserve save the day? I'm going to show you the biggest challenge facing policymakers and why what's coming will outright shock you. Now let's head over to Bloomberg, where we picked today's story up on the headline is U.S. jobless claims have now risen to the highest level in 2 months, and this is on the back on a huge surge in claims in California. And one of the risks here is what's happening in California is soon going to spread all across the country, as you're about to see. Initial claims increased by 17,000 to 242,000 in the week ending December 7th. At the same time, we saw continuing claims, a proxy for the number of people receiving benefits. It also increased now to 1.89 million in the previous week, which also included the Thanksgiving holiday. And this is a major problem for the U.S. economy, and in particular, as we're going to take a look at California, because what we're seeing here is people are losing their job, and because their incomes are going down and their consumption goes down with it, well, other people are finding out that their job is at risk. They're starting to hit the unemployment line, and this is something that we've been warning about, because as people get trapped on unemployment and have no opportunity to re-enter the workforce, over time their consumption shrinks dramatically, because as soon as they realize there is no other work, they have no choice but to cut back. That then spreads right through the rest of the economy, and we can see it very clearly on this chart. When we look at continued unemployment claims in blue against initial claims in red, what we see is where continued claims go, initial claims follow. And this makes perfect sense, because again, the spending of one person is the income of another person. So what we find out is when someone's income goes down because they hit unemployment, their consumption drops. Next thing you know, it affects the income of other people, and all of a sudden employers are forced to slash hours and eventually cut jobs. And that's what we're starting to see. And thinking about where we're at in the holiday season, this isn't normally a time we would expect to see people losing their jobs, suggesting that there's another problem with the economy, and that is demand on a broad basis is nowhere near the hope where retailers and wholesalers wanted it to be. And we could see this relationship going into the global financial crisis. Continued claims continued to slowly move higher, and initial claims followed. And in this cycle, we saw initial claims rise to around 1.8 million, pull back a little bit, rise up near 1.9 million, and now are threatening to get close to that 2 million breakout point. What happened? Initial claims dipped, but it didn't affect those who were on unemployment. There was still a weak demand for labor. It brought initial claims up, pulled back once again, giving everyone hope that we hit the soft landing. And now that the election is passed, what we're seeing is demand didn't turn up. And for employers, this is a huge problem, because for years, they've been hoping something would change, and we've made the case that if we didn't see a big turnout of consumer spending, that eventually, particularly small businesses, would be forced to lay off in a big way. And while weekly data tends to be choppy around the holiday season, the November jobs report released last week showed an increase in the jobless rate to 4.2%, this from the household survey, and in the number of workers who are unemployed for 3 months or more. And this is not a sign of what happens when you're going into a soft landing or a resurgence in the economy. It's an indication that we're heading into recession, because if someone loses their job and they're able to find another one relatively quickly, well, then it's showing that there's strength in the labor market, and that perhaps one sector of the economy isn't as strong as another, and that gives an opportunity for a worker to transition and find another job. But the problem here is when we start to see people on unemployment for 3 months or more, it's a danger sign, and what we're going to now expect to see is initial claims head higher. And wait till you see the California data, because what's happening there is soon to spread all across the country. And on an unadjusted level, initial claims also rose to the highest since January, as California saw the largest increase by far, then followed by Texas and then New York. So you think about some of the most populous states, California and Texas, and well, that's where a lot of jobs are at, and soon there's going to be a lot fewer, as we can see that California and Texas led the weekly change in initial jobless claims. And my friends, this is going to get worse, and significantly worse, and because this is all about consumer spending here, when we take a look at advanced retail sales adjusted for inflation, this shown in red, or what's called real retail sales, and that's shown on a year-over-year rate change against continued unemployment claims, what we can see, and this is exactly what's happening in California and Texas, as people get on unemployment and get stuck there with no opportunity, their spending power decreases, and what happens, that means real retail sales starts to decline, as we see here happening in the late 1990s going into 2000s, and as more people get on unemployment, spending declines and eventually contracts. We see that relationship starting all the way back around 2005, where we see a peak in real retail sales. It decelerated. At the same time, we see a bottoming in the labor market, and then continued claims started to tick up. Real retail sales continued to decline and eventually contract, and when that happened, a lot of businesses, no choice but to lay people off. They have to do this to protect their margins in an attempt to stay in business, and now we're seeing this happen once again, except this time we note that real retail sales have been negative for nearly 3 years in a row, and small businesses and mid-sized businesses have been hanging on by a thread, hoping something would change, and many of them said, well, wait till the election. That was, everyone was pinning all this surge in spending on the election results, and what are we finding out? Initial claims now up 242,000, and that means continued claims pushing up now 1.89 million, suggesting we're going to see a further increase in initial claims. So when we look at what's happening in California, Texas, and New York, we see it's going to spread rapidly, not only across those states, but all over the country, as we now expect continued claims to tick higher. And U.S. producer prices now have jumped on eggs, but Fed categories come in soft. And here's the other risk. We talk about some massive risks to the U.S. economy. It's slowing labor market and rising prices. This is the absolute worst combination. But something that should also be rising with producer prices, that's your trading account, because mine's going up, and you can follow along right with me. Let's take a look at the close of business yesterday. Our CTA Timer Pro, which trades against the machines, we now have 10 open trades. 90% of them are up. That's 9 trades are in the black. Momentum Timer Pro has 8 open trades. 7 trades are up, and we trade against momentum as well, but we run a proprietary overlay against a bunch of momentum signals, and that gives us the edge, sitting on an 89% win rate. But again, you want to know what I'm trading? What trade right alongside me? I tell you what I'm trading, when I'm trading it, so you can get in before I do and out before I do. But let's take a look at one of our big trades recently. This was on DBA, or agricultural commodities. We told our subscribers to both reports because it flagged on the exact same day. You want to buy right here, and this thing has taken off to the tune of 7.59%. And here's the notes that the subscribers get. We give all the details of why we like a trade, when to buy it, their upside target and stop loss levels, all of this in the report, so you get them every day. The tradable signals, I go through every trade to give you my opinion on. We give you back-tested data to show which signals are the best, risk control levels, full tracking of trades and returns, a weekly update, a 30-day free trial, along with my own positions. You want to trade with me, you want to know what I'm trading and why I'm doing it, sign up, hit those links in the description below, because the 30-day free trial is going away, my friends, at the end of the year. The producer price index for final demand rose 0.4% from a month earlier, the most since June. This compared with a year ago, the PPI increased 3%, the largest advance since early 2023. So one of the issues here is we're seeing more Americans hit the unemployment line, which means their incomes are going down. And because they realize that other people they know have been on unemployment for months on end, they're going to see a big decrease in their spending because they're going to be concerned that they can't get another job. At the same time, they're going to see their consumption drop. We're seeing producer prices rise, which backfeeds right into the consumer price index. So at the same time we're seeing higher prices, we're seeing a weaker labor market, and that is the exact recipe we've seen over and over that indicates that the U.S. economy is not about to experience a soft landing, but head right into a recession. A measure excluding food and energy, meanwhile, rose 0.2% on the month and 3.4% from a year earlier. And we talk about the expectations of where consumer prices are going. Well, at least in the short term, we can see producer prices have been rising since late 2023 and are now looking to move higher as we look at final demand. And against this is the consumer price index. So despite the fact that we've seen producer prices on an upward trend, we've seen consumer consumer prices on a downward trend, meaning businesses are taking a loss at the margin. They don't want to sell at the current price. They'd love to sell at a higher price, but just to move goods off the shelves, they're being forced to cut prices for businesses that are already facing now 3 years of negative real retail sales. This is a danger point because if they don't see a pickup in demand and more business, they're going to be forced to cut more hours and cut jobs. It's inevitable of what is coming. We can see the evidence of what's already started in California, Texas, and New York. Because this all comes back to people being on unemployment, you can see on this chart very clearly when prices are rising, as we look at the consumer price index in blue on a year-over-year rate of change against continued unemployment claims in red. As prices go up and unemployment goes up, you hit a recession. You see that relationship once again going into the dot-com bubble, again during the global financial crisis, and we're seeing it now, except the difference is you might say, wait a minute, the consumer price index is in a disinflationary trend, but its current growth rate is indicative of other levels where we've seen recessions. The problem is consumers can't afford prices at these levels, and as more workers hit the unemployment line, fewer people are going to be able to spend, leading, of course, right into a recession. And then it comes back to not just people on unemployment, but those who do have a job, as their spending power is weakening. We look at total incomes now in forms of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, and we see a deceleration in total incomes for those who do have a job, and that's all because there's a growing number of people on the unemployment line. So employers still give out raises. That's not the issue. They still give them out, but they might cut hours even more. And if workers complain, well, it's real simple. They can find someone else on the unemployment line that wants work, particularly when you have people that have been on unemployment for 3 months or more. It's showing you that all of a sudden there's been a shift in terms of when you go back to the pandemic. Employers, they were at a disadvantage. Now they've got the advantage. We see this relationship. Income growth is slowing, and the problem here is it comes back to higher prices. So the time we see price growth trying to turn back up, incomes are heading down, and that's an issue because even those who have jobs still can't afford as much. You see this spiraling out of control, and perhaps a small uptick here was just enough to absorb that little uptick in inflation. But if we do not see income growth turn significantly higher, we're going to see the continued unemployment claims head up as well. And the wholesale inflation data follows the more closely watched consumer price index. It showed Wednesday that underlying inflation remained firm for a fourth month in a row. The string of hotter numbers follows a rapid moderation earlier in 2024. It has added uncertainty over the trajectory for prices and interest rates as the incoming Trump administration threatens higher tariffs on imported goods. Well, one thing we do know is if demand goes down, yes, you can see transitory increases in prices, but eventually prices come down. And anybody who's owned a business realizes this. If you have a lot of inventory and you need to raise the price to protect your margins, but all of a sudden you see less foot traffic, less spending, fewer people buying, well, you have no choice but to cut your prices. But one of the risks then, if we do see tariffs come into play, what we're going to find out is prices are going to forcibly go higher. Existing inventory level will eventually get cleared, but the problem is incoming inventory will be outpriced compared to what people can afford. If we go back to the last time we had tariffs, the economy was expanding and growing, and wages were going up enough so people could afford the higher prices. Today we know there's no way they can. The PPI data showed goods prices jumping 0.7%, the most since February. The BLS said here's the big problem. 80% of the advance was traced to food, as eggs prices surged 55% from a month earlier, largely reflecting the impact of bird flu. So you think about this, they like to look at the core PPI or core CPI. Anytime you see core, it often excludes food and energy. The problem is everybody needs to spend money on food and energy and shelter. Now you can cut back your energy usage and you can stop eating out as much, but if food prices go up at a time when consumers are already facing long-term unemployment, when they're seeing their wage growth slow, and again, it all comes back to less money getting spent on the discretionary side of the economy, and further validates the downward trend we're seeing in the economy and why we're seeing an increase in weekly claims across large states such as California, Texas, and New York. And now let's turn to the Federal Reserve, who faces a major challenge as a neutral rate guessing game comes with high stakes in bond market. Now, why is this a guessing game? Why is the neutral rate? Well, the neutral rate is very simple. It's a level of benchmark interest rates that neither boosts nor slows the U.S. economy. The problem is the Fed, or any central banker, can't quite figure out how to calculate it with any precision in an economy that's still adjusting to all the shocks it got both on the supply and demand side during the pandemic. But look at the excuse that the media gives you. It's all because of the pandemic, and if it wasn't for the pandemic, maybe the policymakers would know what the neutral rate is. The problem is they've never known what the neutral rate is in any given cycle. Throughout time, not one central banker throughout history has ever actually known the neutral rate. It's a guessing game because central bank policy doesn't actually do anything. What we see from central bankers is they respond to the economy. They don't lead the economy, but as long as everyone believes it works and that there's some mythical neutral rate, well, that's all that matters here. Because for years, the neutral rate was widely considered to be pretty low. There were disagreements about the exact level, which doesn't make any sense because the Federal Reserve has more PhD economists on unemployment than anyone else in the world. You think with all of that brain power, they should certainly know exactly where the neutral rate is, but they don't know either. And the broad consensus is formed during the long sluggish expansion that followed the 2008 financial crisis that had it hovered somewhere around 2.5%, but even looking back, we still don't know. And how about this? The formula right now is simple, and what we're seeing in the market is sell long-term bonds and load up on cash along with assets that have a dividend or cash flow characteristics that's much more attractive with a higher neutral rate, like infrastructure or real estate. That's because what we're seeing from market participants is they're convinced that the neutral rate is higher. But when we start to look at the labor market, we look at incomes, we look at real retail sales, we don't see a higher neutral rate. What we see is an economy heading to a recession, and we see central bankers cutting in a major way, just like we found out today as the ECB cuts for the third straight time to prop up flagging economy. Only a matter of time before the Fed is aggressively cutting rates as the labor market unwinds. But the ECB wasn't the only one cutting rates. The Swiss National Bank followed Wednesday's decision by Bank of Canada to lower by 50 basis points. The Fed, meanwhile, will likely cut next week by a quarter basis point as expected by the market. And commenting on the neutral rate, Lagarde said it's subject that will be discussed in the future, probably as the ECB gets closer to it. Again, here you see it's not just the Fed that doesn't know. It's not just the Swiss National Bank or the Bank of Canada. It's European central bankers. They don't have a clue either. All they know is they're cutting rates, looking for something that they have no idea what it is. The conventional wisdom around the table is probably a little higher than where it was before. We'll debate it in due course, but it's premature to do so at the moment because, again, it doesn't matter. The economy is falling apart, and so they need to cut rates. And this is all in response to what's happening in the economy. And let's look at some U.S. data because it's very, very clear. Look at what happens going back to 1999. Real retail sales, shown in red, decelerates and contracts. The Fed responds by cutting, doesn't make any difference. In fact, the Fed cuts from massively around 6.5% all the way down to about 3% before anything seems to change. When we move forward to late 2005, we see a deceleration in real retail sales that goes into contraction. It wasn't until 2007 the Fed's cutting rates from just over 5% all the way down to 2% before anything even starts to slow down. And even then it didn't. The Fed had to get down to 0% before they saw a turnaround. How about now? We have 3 years of negative real retail sales. The Fed thinks they just need another quarter basis point cut. Not likely. But how about incomes? Everyone thinks incomes are going to turn higher. But look at this. Compared to the Fed funds rate, what do you see? Incomes decelerate. Fed cuts rates. They continue to decelerate. Happened again in the global financial crisis. Likely to happen a third time now. And when we turn to the labor market, that we're looking for this mythical neutral rate, and the Fed rate cuts do everything to solve the problem. What you see is when the labor market starts to unwind, the Fed reacts to it. Just like it reacts to slowing wages, just like it reacts to, of course, retail sales, you see it's a reaction to what's going on in the economy. And by the time the Fed gets to actually doing anything, it's far too little and far too late, suggesting what is likely to come is further unemployment claims in terms of more Americans losing their job and central bankers all over the world cutting rates. And that's why we started the show out saying it's time to prepare now. And with that, I'm Steve Van Metre, and thanks for watching. Thanks for being fans. Bye now.